We'll just take a moment to prepare up for the next technical session, and we'll be back again. Technical session centered around role of governance towards quality in financial reporting, and it gives me immense pleasure to invite our session chair, Dr. S. Ravi, former chairman BSC India and founder Ravi Rajan & Co. Welcome, sir. Let's have a huge round of applause, ladies and gentlemen. And as the speakers for this session, I invite Mr. Vikram Kukreja, Chartered Accountant, Mr. C.A. Pawan Kumar Agrawal, Chief Executive Officer, IPP Business Wari, Mr. Amrendra Kumar Sinha, Chief Audit Executive, Adani Green Energy Limited, Mr. Chetan Mathur, Independent Non-Executive Director, Pratap Snacks Limited and ex-CFO, Pepsi Limited. Let's have a huge round of applause, ladies and gentlemen, for all the dignitaries on the dais. Before we start off, I would request Sir Basudev Mukherjee, sir, to please felicitate our dignitaries. Can we have the planters, please? Starting off with Dr. S. Ravi, sir. Let's have a huge round of applause, ladies and gentlemen. To Mr. Kukreja. Let's hear it, sir. To Mr. C.A. Pawan Kumar Agrawal, to Mr. Amrendra Kumar Sinha, and to Mr. Chetan Mathur. A huge round of applause, ladies and gentlemen. Thank you, sir. So, ladies and gentlemen, as we start with the next technical session, just a quick announcement for our speakers. I would request all of you to please be considerate of the time as we are already running behind schedule. I would now hand over to Dr. S. Ravi to please start with the proceedings. Over to you, sir.
So, good afternoon to everybody, and thank you for the invite. Well, I was just hearing the discussions that were going on, and financial reporting has become a very important and integral part of all of us. Of course, my co-panelists, Mr. Vikram, Mr. Mathur, Mr. Amrinder, all of us are here, Mr. Pawan. So we will, articulate and let the speakers speak on this subject. My viewpoint on this is very specific. Having been on the regulator's side, running an accounting firm, heading an accounting firm, and also being on the board, and so I have a three-dimensional view on this. And what I personally feel is that we are going through a very important phase as far as the financial world is concerned. We have independent directors on one side, we have the credit rating agencies, we have the bankers, and then we have the CFO, the KMPs, and then of course the multiple regulators and global transactions, which are also, more and more companies are going global. So you are seeing a lot of global transactions too. And the regulators' conflicts are also there, which is visible. And every regulator has a certain prescription. And I think the biggest challenge for all of us is to ensure that all the regulators and regulatory compliances are completely done. So amongst the maze of all these sort of stakeholders, one has to go through this. And I think the financial reporting has become a very integral part, and there is no tolerance, there is no there is no leeway for anybody, and only the quality of reporting is going to be higher. More disclosures will come into place, and I think that is the way I look the way forward. And multiple regulators, as I said, are having their own sort of list of compliances. That is what is the biggest challenge. So with that, I would straight away tell Mr. Vikram Kukreja about what he feels about the controls of the financial statement, how robust controls can improve the financial reporting. So I would request him to take it on.
Thank you, sir. Good afternoon, everyone, and thank you, SOCHAM, for having me here to speak on this topic, which is controls around financial statement close process and how robust controls can improve the financial reporting. So as chartered accountants, we are very passionate about this topic because risk controls, we deal with them day in, day out. But this topic is very relevant to all of you, including me, because financial statement close is something which we do 12 times in a year with added emphasis at the year end and even in quarters for the listed companies, right? So can I have show of hands who has done the financial reporting close process or who has handled at any point of time? Surprised to see very few hands, but that's okay. So I'll quickly jump on to the presentation, and I have been told that I have limited time, so I'll try to cover it within that time itself. So what is a financial statement close process? So financial statement close process, is a series of activities which is performed by a finance team of a company at each period end, and the objective is to produce the reliable financial information which is helpful to take decisions and also in doing regulatory compliance. So that is the basic definition of financial statement close process. Amit mentioned in his session that controls and reporting go hand in hand and they are not separate. So what is a control? I mean, while it looks a very complicated definition, but control is something which are the checks and balances within the system in order to prevent an organization from risks. So that is the basic definition of a control. And these can be of two types, and it can be broadly classified into preventive and detective controls. Preventive controls are something which can actually prevent a loss, whereas detective controls can only give you an evidence of a loss that it has been occurred. So which is better? I mean, we have heard from our childhood days that prevention is better than cure. So definitely preventive controls are better, but an organization has to see the constraints around it, and what I have seen generally is that they deploy a combination of preventive and detective controls to mitigate risk and to achieve its objective, which is by and large earning profits for its stakeholders and optimize their wealth. Now, let me come straight away to the risks associated with the financial statement close process. So how do you define risk, first of all? Risks are something which will prevent a financial statement from being reliable. So what can cause that reliability of the financial statement? So there are certain factors. You can see this list. This is again not exhaustive, but there are only few of the risks which I'll cover, like not having segregation of duties in place. So what does it mean? It means that, for example, in a purchase to payable process, somebody who is approving the purchase order is also responsible for approving the payment. So there is a clear issue with the segregation of duties. A person who is hiring employees is also responsible for payment of salaries. So there is a clear issue with segregation of duties. So unless you have this particular control in place, it is not an assurance that you will get the reliable financial information for decision making. Another risk which is there is unauthorized changes to the master file data. So master file data is something like employee file data, vendor master, and the information like bank account information of a vendor. So, I mean, if there is no process in place to have that risk mitigated, whereby one can make unauthorized changes to the master data, I mean, there is an issue with the reliable financial information which you want to achieve from the financial reporting process. So similar to unauthorized changes to master data, we can have unauthorized changes to the general ledger and sub ledgers. All the entries or transactions which are posted in the sub ledger may not be recorded in the general ledger. With these complex ERPs which we have in place these days, it is highly unlikely that this will happen, but in case this is happening, that is again a risk to have the reliable financial information. Then we also have certain more risks which I will not talk about, and move on directly to the controls part. So business performance review is one of the most exercise controls in the financial statement review process or a financial statement close process. The organizations compare the data or the information numbers of the current period with the previous period and also with the budgets to see whether they are actually going on track and if there is a need to take any corrective measures. That is the whole purpose of this control. Segregation of duties. We talked about segregation of duties. What can happen if you do not have segregation of duties? So that is again an important control, not only in financial statement close process, but anywhere else also, in any other significant business process. Access rights review. So this control ensures that whatever access you have got in the ERP system, those should be in line with your job responsibilities. Like a purchase manager should not have access to something in marketing module, right? Standing data change controls. So standing data, as I mentioned, it's a vendor master. To take an example, so if someone can make unauthorized changes, this is a risk, and to mitigate that risk, you need to have that control, whereby all such changes are authorized properly by the management. So similar to that, accounting policies review for compliance with GAAP, manual review of financial statements, comparison between the adjustment posted and source documents. So this is the most traditional form of a control which one can have. So whatever adjustment you are making, you need to have supporting documentation or justification. And I'll talk about one more important control which we have seen from our experience, which is having a checklist in place whereby every series of all the series of activities in the financial statement close process is mentioned, who is responsible for doing what, and along with a timeline and who is going to review what. So when you have this clear communication in place, there are chances that it is highly unlikely that you will have any risk. But despite doing all this, there is still a possibility that your financial statement may not be reliable, because having controls, assessment of risk, it does not give you an absolute assurance, but you can only have reasonable assurance that whatever financial statement you are getting is reliable and okay to take decisions. Now, how can robust controls improve your financial reporting process? Definitely, if you have those important controls in place which are responsive to those risks, the risk will be reduced. You will have timely insights to take decisions. You have limited errors, and obviously you will have compliance with laws and regulations. So that's all you can achieve through the financial statement reporting process and having the controls in place to mitigate the risk. Now let us understand what are the challenges which the finance professionals face in their day-to-day lives, and what could be some of the best practices to encounter those challenges. So one of the major issue which has been observed in a close reporting process is the data quality issues. So what happens is that the data is not accurate or it is not complete, thereby leading significant delays in closure of books and also the errors in the financial statements. So first I'll talk about challenges, then I'll come to the best practices. So another challenge is the manual processes, because dependence on manual process can not only take more time but also the risk of errors. Then system integration challenges. There could be multiple systems being used by many organizations which may not integrate with each other, and there may be a reconciliation issues at each period end. Then lack of standardization. This is something when you have various departments who are following the inconsistent processes. Then time pressure. As finance professionals, we all understand time pressure. It has been observed that organizations take 7 to 10 days to close their month, and some organizations even take 15 days or more. So once you have a breather, another month closes on your calendar, and the process goes on, right? So time pressure may lead to rush decisions and with potential oversights. Complex transactions. So any organization which is a large organization can have merger acquisitions, and to do that accounting, you need a significant oversight. So that is again a challenge in the financial statement close process. So now let us understand what could be the best practices. So you can have establish robust data cleansing, validation, and quality checks. Like everybody files the income tax return, right? So when you try to submit the income tax return, there are a lot of validation checks which happen, and it will not let you submit your income tax return unless you have cleared all the validation errors. So similar to that, for monthly data or period close data, you can have those validation checks in place to ensure that whatever data you are submitting to the higher management is accurate and complete. Then, we talked a lot about artificial intelligence in the last session and machine learning, robotic process automation. You can have these things to, remove or try to eliminate the manual process as much as possible. Few of the examples of where automation can be done is direct import of data from the bank statement and doing the reconciliation. Routine journal entries can be directly posted, like the depreciation entry, if you give some of the parameters or the predefined rules. So with that sort of automation, we have even heard that even the surgeries are, being done through robotics. And we can also see, cars running without a driver at some point of time. We all hope to see that. So financial statement close process can definitely be automated. Then, we talked about system integration challenge. Then there you can integrate your systems to have a streamlining in the data flow. Standardization, you can have a clear sort of a checklist or something whereby, you can standardize your process and communicate very clearly. Time pressure is something you can manage with the help of a checklist with clearly defined roles and responsibility and effective communication. And finally, for complex transactions, you should have a definite regular monitoring and review to take care of such transactions because they definitely need more time. So with this, I close my presentation. Thank you so much.
Thank you, Mr. Vikram, for giving us this input on standardization as well as data quality. Now over to Mr. Pavan Agrawal. Of course, it's a very touchy subject about NFRA, and today just I was showing, we got a flash that NFRA has objected to the institute's standards which they have issued yesterday. So I think between the regulators there are issues. So just a perspective of what are the concerns of NFRA in the financial reporting, we can dwell on it.
Thank you. Good afternoon, everyone. We just heard, I think Mr. Arun, I'm forgetting his name, that once we discuss any topic technically, or when we discuss any particular issue, we often lose the overall perspective, right? Now, the whole objective of all these regulatory bodies that have been put in place is just to make sure that the quality of reporting is something which is, again, back to the basics, true and fair. Now, when things starts becoming more complex and all of us are living in more complex environment, the obligation of reporting or the quality of reporting becomes far, far more important. And for any company, it is a financial statement, and more importantly, it is the audited financial statement. That is possibly one of the first thing that any investor, whether it is equity investor or any lender or any regulator look for. The credibility of financial statement talks about credibility of the company, credibility of the management team, and credibility of the auditor. There have been incidents in the past, series of incidents which possibly led to we having a regulator, NFRA, which possibly was not there. Not that any one of us doubt the integrity of our own institute. However, at times when things become a lot more demanding, when the output of a financial report is something which is very, very crucial for a lot of decisions by a lot of stakeholders, then the necessity of regulators should be welcome as long as everything is being done in a very, very constructive manner. We have seen some of the findings that has happened after NFRA came into place, some of the case laws, some of the High Court orders, Supreme Court orders that talks about that possibly NFRA is doing a job which was very, very critical and essential. The fact that auditor could resign thinking that, okay, they have smelled something, and by stepping away, possibly they'll be able to relieve of their responsibility. Now, those things have been knuckled in a very, very stringent manner under NFRA. So, when it comes to financial reporting, it is about governance, it is about disclosures, and from that overall perspective, the role that NFRA is playing is very, very important, very, very necessary actually. We also heard that if you're talking about taking the image of India to a developed economy, if you're talking about people relying on our disclosures or our statements the way we are relying on, possibly, we talk about that if it is a US GAAP disclosure, if it is an annual report which is filed by way of 20F or 6K, the level of disclosure or level of reliability is far more than possibly by any other standard. Now, those things are converging, and while this has put a lot of challenge on we as a, because ultimately we are the owner of financial statement, right? Auditor is just doing auditing job. Of course, a lot of responsibility and liability has been put on auditor, but primarily it is a statement of company affairs. It is the CEO who is signing as a CEO of the company. It is the CFO who is signing as the CFO, Director of Finance. So the responsibility of financial statement lies with the management team and company beyond doubt. But there was a very long period wherein the fact that financial statement are owned by the company, it is the management responsibility to prepare financial statement, that was being used as a veil or as a shield by auditor, not in a very direct manner, but then auditor taking management representation, auditor possibly seeing through something, but then trying to find out ways that, okay, if you have these evidences, if you have these supporting legal opinions, if you have these management representations, possibly we have done our job because we are not supposed to be getting into too much of detail. So the entire role of NFRA and or the entire reason why NFRA came into place, that for the companies which are of importance, right? If it is a listed company, it becomes important by default because it is dealing with public money. If it is a company of a certain size, whether we call it 500 crore net worth, 1000 crore turnover, or 500 crore debt, it becomes significance in its own respect. And then similarly, the companies like banks, electricity company, insurance company. So all these entities which are otherwise very important from a public interest in general, and of course there is a public interest separate clause. So all auditors of all these companies need to be under a special supervision, and that is how the word of investigation has been used in the entire NFRA, that they can be investigated by NFRA. Idea is that auditor cannot take a convenient way or convenient route that, okay, because of A, B, C, D, and this is anyways a statement of financials of a company, or it is a management responsibility to prepare financials, and we have done, we have taken relevant reports or relevant representation or relevant legal opinions, stuff like that. So on that basis, we are relieved from any liability when it comes to that something wrong has happened with the reporting. So idea is that these financial statement should be as much owned by the management as by the auditor. Of course, the ownership, technical terms, it remains with the management, but auditor working very closely with the management, and auditor knowing that how critical are all these disclosures and all this accounting for all the stakeholder, whether it is government, whether it is investor, whether it is lender. So having all these arrangement or the entire framework is something which is very constructive. It is helping us as we talk, and it will continue to help in long run. Thank you.
A very good perspective given by him, but one thing that I would like to means everybody to understand, there can be always interpretation issues which is very common. Something that is malified, bona fide, interpretation issues, everybody should actually classify all this when we look into an account, even NFRA or anybody looks into it, the genuineness of the whole thing. There can be transactions. Now I'll give you an example which is without taking much time. Insurance sector suddenly has seen a lot of demand from GST. Now the whole industry has gone and appealed. Now most of the management feels that they will not recognize this because this has been done retrospectively. There is a bit of contest there, and finally you saw through that the GST Council has reversed it in a big way, giving relief. So how does the auditor react to this? Means they just say that these show causes have come or the demand has come, and then what happens in the next quarter? You are reversing the whole thing. then somebody will say, okay, you are understated or overstated. So I think there are calls and examples which are there, which I think it's a very specific call which the management and the auditors have to take. We cannot generalize this, and it is important to understand all these circumstances. That's all from my side. Mr. Sinha, the role of internal audit and the quality of financial and ESG reporting. ESG is a very important aspect. Most listed companies are coming with a ESG policy and ESG initiative. Yeah.
Good afternoon, everyone. And I think we are running short of time, and that's how for ESG also we are running short of time to implement that. So, I have my presentation, please, on this? My presentation on this? Till the time they load my presentation. So ESG, since the morning we discussed, I think everybody knows now that what is ESG. But problem is that whom you are asking, and you will get the answer what is ESG. So if you are asking the person who are doing this, so they will tell everything seems good. The person who are doing the ESG. The moment you ask the investors, they will say that everything seems grey. So as an internal auditor, what is our role is that how to convert this from everything seems good to everything seems grey, and for what? That everyone should gain from this. That's what ESG is for me. And more basically today is International Poverty Eradication Day also. So I think we need to do much more in that so that they also get benefit out of it. Then till the time they get my presentations, I think I will just take this forward. Yes. Okay. So from internal audit side, you can't directly audit anything unless the things exist. And that's what ESG in the most of the company as of now. So being the third line of defense or last line of defense, whatsoever you want to define it, first you have to work with management to see that for defending anything, things must exist there. And that's how ESG audit has to be planned. And since internal audit is all about risk-based, and now if you see any risk survey by the EY, by any risk agency, by any survey agency you see, since ESG is coming at a risk, and you are as internal auditor being a risk-based audit plan, so it's needless to mention that ESG will feature in your audit plan. If not now, you are already running late. So it has to feature in your internal audit plan because it's coming everywhere as a risk. Now second, that how should you plan? If it already come to the internal audit plan as a risk, as an internal auditor, what should you do? You have a 2-3 different approaches depending on your organization's current standing and maturity of the ESG as of now. Whether this running already since last 2-3 years, then your strategy will be little different. If they are just starting this ESG framework, then you can work along with management to help them as an advisory role rather than the auditing role to set up a good context and framework so that in future that is beneficial for all, and then you can audit also. Now, not even that, even if you plan for the audit, who will audit that? Every time you want to co-source it, outsource it, or you have to develop your internal audit team who can continuously do it. And for that you need to invest it from day one. And how you develop your internal audit own team? By educating them to giving training everywhere, to sending conferences, seminars, at least give them materials and the forum that they understand and build their skill to audit. Now, since if they are having the audit domain, audit knowledge, it's not much different the idea of auditing. Like they are doing ICOFAR, they can also do international control over sustainable reporting also. So what they need to do, they need to understand what is sustainability as a large. Once they know sustainability at a large, they can copy their entire internal audit procedure in terms of risk assessment, control matrix, RSCM, control objective, design effectiveness, and all other things. But first they have to understand what is sustainability. And that for that matter, you have to train your resources gradually. Now, third challenge is that for auditing finance, it's very easy that you get the balance sheet, trial balance, balance sheet, cash flow, and other statement ready. But how will you audit ESG? Because there are so many different reports prepared under different standard that how to take base and where to start. Every company will have a different standard followed. And it's not that the company has chosen different because they want to know it, because every standard, every stakeholder wants their reporting of ESG in the different format. Some investor wants some different format, some other investor wants in the different format. And then there accordingly that reporting framework as well. So as an internal auditor, you need to go through so many standards. So what are good things in that? The good things is that there are standards, so you can take a reference and you can audit it. And the bad things that there are so many standards that you need to identify, unify it first, that how and what standard is best suited for my company in that. Now even having said that, ESG is not a common goal for all in the same scale and same context. If you talk about UN SDG, there are 17 different goals. Your company, depending on their nature of operation or domains, might not be focusing on all these 17 goals. So as an internal auditor, first you need to understand that what is your company's vision on ESG, on which goals they are focusing, so that you can align your audit program, you can align your resources, education towards that, so that your audit program is matching with the company's vision who are trying to address this UN SDG in a phased manner. Okay. Coming back to that, who all are stakeholders in that and who all are monitoring this. So you have a COP, you know that last time COP 28 that took place in the UAE. Like all the good things and bad things, they need COP. Similarly, we have a COP, that is Conference of Party for the ESG, also to monitor and to give you knowledge that what is happening at the global level and then how you can align yourself to the global initiatives. Third, that internal audit challenges, how they challenge in ESG audit. You can't get a ready-made data for the ESG. Like I'm coming from Adani, which runs in the 15 different states, and I personally look after 120 odd locations as a renewable energy. Now getting and collects data for from all these 120 locations itself is a challenge. So unless you have a technological platform to gather all the details in the standard, meaningful, template and relevant, and not only that, one time you can collect the details. Okay. So now you got my presentation, but anyway, let's continue. So now you know that 120 different locations, continuous detailed presentation on that. You have to have a technology. And who can help you in the technology? That now you are already using earlier ERP, SAP and all, now you have already started using cloud. You need to ensure from day one that all your technology, all our technology are the cloud-enabled platform. Otherwise, you will not, let me tell you, you will not be able to handle, you will not be able to manage at the real-time basis all the documents and presentation, analysis. Unless you have the different details, you will not be able to audit and give any meaningful result to the management. One more thing that most important is that comparability. Right now, if you want to compare ESG report of different companies, for that you need to have a common set of numerator and denominators. Unless you have the same scale and size, the report you can't compare. What is 5% and what is 5? You will not be able to know that whether they are good in ESG or you are good in ESG. So comparability, and there your standard normally helps. Okay. So this I just prepared that how many standards, and few slides I will just try to take you. That COP we discussed. Yeah, these are the standard goals. So you have to pick from all these 17 UN SDG goals. Now just last 2 minutes on that. Whenever you see anybody talking about ESG or environment, you see that CO2 and all. If you go deeper into that, ESG is not only about CO2 emission and all, there are so many other things as well. And that requires your auditor to have a knowledge at the next level to audit and contribute it in selective manner. Now this is a new thing, that scope 1, scope 2, scope 3. Unless you know what is scope 1, scope 2 and scope 3, you will not be able to give any meaningful audit reports. Scope 1, anyway, you know that this is directly influenced by the producer or you are the consuming that, and the scope 2 is nothing but the supply chain. The major is a scope 3. How will you get all the details for the scope 3 and then measure? So these are some challenges we are facing, and they are good part that now all the standards are getting merged at the ISSB level, and for which IFRS has come with two different standards called S1 and S2, where S1 gives you the general disclosure and S2 gives you the climate related disclosure, which you can align your own working, and that will help you. Apart from that, I think in the interest of time I would like to close here, and thank you very much.
Thank you, Mr. Sinha, for giving a perspective. Yes, the global standards are getting integrated as we talk, because you mentioned about carbon-free, methane-free. All these are part of Viksit Bharat also, 2047, our aspiration. So there are the ESG is going to make a lot of prominence in the whole setup, and I think from a learning perspective also, auditors, for the auditors also, actually there are many courses which actually train the auditors, and they have 180 days program, etc., for people to actually, there are certification courses too. So now moving on, I think I'll ask Mr. Chetan Mathur to come in and talk about board level and CFO perspective, especially pertaining to quality reporting, which is a very important aspect. Thank you.
Good afternoon. On this ESG subject, I mean, those who are independent directors or directors of the board, you may want to explore the IICA program. I attended it 2 weeks ago. It's awesome. They bring in real good specialists. They bring in simplified knowledge, help you understand what you can do to drive, let's say, better governance on ESG. Of course, the Institute's program obviously would be addressed more to the accountants. So when I was asked to talk about this subject, I took the liberty of reaching out to 15, 20 people who are a mix between independent directors, audit chairs, CFOs, and saying, guys, sitting back at 30,000 foot level, tell me what are your pain points, okay? What would you like to bring, what would you like to mention at a conference like this? Again, there are a lot of details that have been shared. I think there's been a lot of great perspectives that have come in here. However, I'm going to probably, even at the sake of repetition, share with you some of the inputs that I got. But to me, let's say understanding problems or hearing problems is half the story. The more important is what are we going to do to make that change? Because honestly, that is going to be the differentiator in today's world. I mean, problems are there, and that's why we are created, and therefore we need to figure a way to go forward. And that's what this conference is all about, right? We've come here to hear people, to hear, okay, and to understand, and then take back and make an action plan for ourselves. So what you do here consistently, and we heard it today many a time, that the environment is changing rapidly, right? The life cycle of our product tends to be short, as short as few months today. Now, if the rapidly evolving regulatory or accounting or governance, what do? The suggestion is invest in specialists. Whether you are an independent director or you are a CFO or part of the CXO community, there is no way that you can, let's say, know everything. So empower your secretarial team, empower your legal team bring in the specialists. I think Dr. Haldia kind of mentioned it. If reporting is so important, I come from a PepsiCo background, so in the US companies, there is a CFO and there is a controller. The financial controller is an independent set of organization which runs through right from New York to the operating company. Of course, there is a strong relationship with the CFOs. However, they are independent. And you are able to invest both time, attention, technology and all of that to build that expertise. I think we in India, we still have generous roles, right? A CFO is responsible for accounting, and we slap him many times but guess what? He's not the specialist in that point, because he's also the CRO, by the way, and in many other cases, he's asked to lead the IT function, etc., etc. So there is a need. I think there is a thought that we need to invest in, right? Bring in specialists to aid this process. The second piece around data quality, I think there is a challenge around that. And yes, technology has a big role to play. But technology again comes with a challenge, which is the cybersecurity piece, which is a whole lot of stuff. For example, HBR had an article not very long ago, less than 2 months ago, something, saying should boards engage in AI, right? And again, they obviously had a kind of a survey, and many people said, what will boards understand of AI, right? Isn't this pure technology piece? But the example really is that you have a salesman who is on your system, he or she uses AI to give you an answer, and guess what? You're opening your information out in the open. Because once your data is put out in that place, in the open, it's now available to everybody. So don't be surprised when you hear your competition tell you, I'll tell you what you do, right? So again, the point again is that yes, we all need to engage in AI, even though it may not be easy to understand. I'm going to leave you with a couple of other thoughts, and I had this gentleman I met just a little while ago who's on the audit committee, sir, and he's not a finance guy, and again, it's a struggle. Believe you me, sir, you are probably the most important person in that audit committee, and the reason why I say is that diversity is important. Bringing in different perspectives on an audit committee is important. Not everybody needs to be an accountant. However, what I must demand as an audit committee is train me, explain to me in simple language. Don't tell me geeky gawk. I mean, okay, sorry, when people have talked about IAS, AS, some of us don't understand it. I'm an accountant, so I can't even pretend I don't understand it. But the amount of acronyms you use, I get lost. So, but I have the right to know, and therefore please stand up and call that out. I mean, what I mean is, don't be shy, guys. I mean, we are going to take that decision. These 5 lines of defense are music to my ears. We've been kind of struggling in identifying who all are responsible, and it's good that we've been called out, right? Last but not the least is, don't scare good people from taking on independent director roles. What do I mean by that? Between the SEBIs of the world and various other regulators, most good, let's say, potential independent directors are scared of going to jail. Okay, and therefore you don't get good quality people onto the board. And if you don't get good quality of people on the board, guess what? We're not going to get good quality reporting, right? I mean, again, if you're from the technology place, garbage in, what's out? Garbage out. Okay, point I'm making is that I think there is a need, and there is, I think we all owe it to ourselves to facilitate the best talent coming into the room, especially in this space. of directors, independent directors, and audit committee. So thank you very much.
Thank you, Mr. Mathur, for giving a perspective of how the independent directors, quality of independent directors, and also about the general perspective. I would like to add a few things before we close this session, because so as I said, I started with a three-dimensional view. The auditors have a view, the company has a view, the regulators have a view, and all stakeholders, including the minority stakeholders, have a view, and the business environment itself is not easy, and it's complex with so many things that is going on, including a lot of global transactions, cross-border transactions, and also the type of business model where we are multiply regulated. And that's the challenge today. A company, a holding company, has many subsidiaries, and which has got, it is multiply regulated. So how the CFO's role or the group CFO's level become very, very important. The group auditor becomes very important. And I think there is there needs to be a consensus of standardization somewhere, because what happens is, so I'm doing a consolidation of a bank. I must tell you, there are 51 international units from where the data comes. We mentioned about data quality. So data quality has to be there. And then how do we filter the data? Then how do we go forward to see that this data is not changed? See, because data can be changed also. How to protect that data in the transmission? Then to put it in the format of a trial balance, then go to a financial statement, and then adjustments. And believe it, adjustments is one of the very key aspects for an auditor. And then the CFO and the whole team to agree on to the set of things, then to go through the notes, then to go through the disclosures, and that too on a very limited space, where we start in September 15th or so, or first week of October. We want the results by the 25th or 26th in an automated environment though, but still there are judgments. There are various qualitative judgments which the auditor has to take, and also the CFOs have to take, the management have to take. And I think it's a very challenging environment. And here what is happening is the timeline pressure. You mentioned 12 reports in a year. So the challenging environment of reporting on time. So here, as we progress and as we bring in new statutes, new guidance, it's important to give time to the auditors and the management to adopt to that. And that is where I think the regulators will have to play a role to give a plan. They just should not put a plan, give a regulation and say you implement. You require a runway to implement. And I think that is what the profession and the chartered accountants, the CFOs and all must have that vision of giving something in advance so that we can simulate and go forward. For example, audit trail. Audit trail is such a easy thing, and it's a very complex thing, because nobody would like to give a data to us. The audit trail sits with the company. Nobody does pass it on to us. Now somebody comes and asks my working paper, can I have an audit trail? I cannot. I have to go back to the system and get the audit trail. So these are type of things which are been brought in, but I think there should be practical solutions, and that is what is a must. And people like Mr. Ashok Haldia, who has seen the institute, sees the regulator, people like them should converge all these people together and make a better tomorrow. If at all, we have to increase the quality of financial reporting, and also see that people are, in tune, and there are standards which are put in place. Thank you so much for bearing with us, and thank you for everything.
Thank you, sir. Indeed a pleasure hearing all the dignitaries here. Let's have a huge round of applause once again for the technical session that we witnessed. I urge all the speakers to please step forward for a group photograph. So ladies and gentlemen, you were witnessing the session around role of governance towards quality in financial reporting. Thank you. So ladies and gentlemen, with that we now break for lunch and we'll see you back again at 3 p.m. sharp with the next session, which will be subjected around regulatory focus and technology in financial reporting. Thank you. All right, ladies and gentlemen, good afternoon and welcome again to the post-lunch session of National Conference around Changing Landscape of Accounting and Reporting, subjected around navigating global standards and best practices. Ladies and gentlemen, you shall be witnessing the last and final technical session of today's conference centered around regulatory focus and technology in financial reporting. And it gives me immense pleasure and privilege to invite our session chair, Chartered Accountant Dr. Ashok Haldia, Chairman ASSOCHAM Task Force for Accounting Standards, Sustainability Accounting and Integrated Financial Reporting. Let's have a huge round of applause for sir. Welcome, sir. As the speakers for this session, it gives me immense pleasure to invite CA Vidyankar Kulkarni, Senior Consultant, National Financial Reporting Authority, NAFRA, Mr. Ashish Shivhare, Partner, True and Fair Professional Network, Mr. Ajit Vishwanath, Partner, BSR & Co. LLP, and our special keynote addressee, CA MP Vijay Kumar, Past Chairman, Accounting Standard Board, ICAI, Independent Director on Corporate Boards and Member, IFRS Interpretation Committee. Let's have a huge round of applause for our dignitaries. Welcome, sir. As we start this session, it gives me immense pleasure to invite Basudev Mukherjee, sir, to please felicitate our dignitaries. Starting off with Dr. Ashok Haldia, sir. Let's have a huge round of applause, ladies and gentlemen. CA Vidyadhar Kulkarni, sir. Mr. Ashish Shivhare, sir. To Mr. Ajit Vishwanath. Let's have a huge round of applause, ladies and gentlemen. We've just had a delicious lunch, so I'm sure the energies are a little high. All right. So with that, I now hand over to Dr. Haldia, sir, to please start with the proceedings.
A very good afternoon, ladies and gentlemen. I know we are in the post-lunch session, which is very challenging for all of you to remain attentive and challenging for the distinguished panelists sitting here to keep you awake throughout the session. And I'm quite conscious of the challenge that we, both of us, have for you to remain attentive and for us to keep you remain attentive. The way we have structured the session is that we would request our distinguished panelists, Mr. Ashish and Mr. Ajit, to make their presentation or in 10 minutes time. And then we would, I would request Mr. Vidyadhar Kulkarni to give his address and his perspective. And then we will have at least about half an hour for the interaction. I know it would have been very painful for all of you to continue to listen to the distinguished experts and at the same time no opportunity to express your thoughts, views or ask questions. So the equitable justice would require that that opportunity should be made available to you. And ladies and gentlemen, we would have at 4 o'clock a distinguished speaker, Mr. MP Vijay Kumar. Mr. MP Vijay Kumar is a very known expert, not only in accounting, but also he's on a board of LIC and many other reputed organizations. And his topic is organizing an organization for ensuring effective compliance of the accounting standards. We have been talking of the technicalities of the accounting standards, but it's not only purely technical areas, but it's also how to manage the compliance. To me, more than knowing the technical standards, it is important that you know the art of complying the technical standards. So Mr. MP Vijay Kumar, not only having a standard setting experience nationally and internationally, but also a proven manager and also having a board perspective, he will be talking on that topic. So that would be at around 4 o'clock. He will join us online. And with that, I will not make any preambles. I'll just state a request to Mr. Ashish. And you know, he has a challenge before him to cover a technology in 10 minutes time. But that's how the technology should enable us.
Good afternoon, everyone. I have a presentation, by the way, if that can be run. Okay. Good afternoon, everyone. My name is Ashish Shivhare. I am a chartered accountant and partner with True and Fair Professionals Network. Let me begin by thanking ASSOCHAM and Dr. Haldia for inviting me to be part of such an elite panel. So thank you very much, sir. And thanks ASSOCHAM as well for that. So post lunch session, that too about technology in 10 minutes, very, very difficult, but I'll attempt to sort of cover it in 10 minutes. The topic given to me was enablers, barriers and strategies for adopting new technology in accounting matters, right? So we are in an age of technological advancement. It's very fast-paced moment when it comes to technology, and as an accountant, we also attempt to sort of find solution in technology for our problems, right? Sometimes I wonder, are we heading towards the age of, say, Ramayana Kal or Mahabharat Kal in Treta Yuga or Dwapar Yuga, wherein arrow used to go, we have seen in the old serials, right? Arrow used to go and come back. That is what Elon Musk has demonstrated couple of, or maybe 2-3 days back, right? So such a technology advancement which is happening, and we need to keep as an accountant, as a finance professional to pace with that. So when we talk about challenges, some of the challenges, although I have listed down here, it's not comprehensive though, but yeah, these are the primary issues that we as an accountant, we as a finance professional faces, whether it comes to data security, it comes to integrity or compliance part of it, lack of real-time reporting for the management to assess what decision they need to take. Fraud and security risk, right? Many a times we have spoken about in the earlier session as well about the security posture risk, about the compliance risk, limited information available to the management to take the informed decision, right? One additional point I have added as part of the challenges, based on my experience, we have noted that consolidation is one of the pain points that any finance professional faces, right? To sort of consolidate the financial statement for subsidiary or associate or whatever. So, so how technology can help, streamline that process, reduce the error in the process, whether it's a finance professional to the satisfaction of the auditors as well. So we will delve into it in the subsequent slide. So now what are the solutions that we talk about? So solution could be one of the basic element of technology-led solution that can be adopted as ERP, right? Of course, bigger organizations have already adopted that ERP. They have ERP in place, but there are challenges as well. So how you implement, we will talk about it in subsequent slides. RPA, it's basically everyone knows what is RPA. If you look at the GCC shared service scenarios, this is highly used. Artificial intelligence, one of the technology solution, how you can implement to tailor to your organization's requirement needs to be assessed. Cloud computing, that's there for a while now. To what extent we are leveraging, I have seen many clients that they are still hesitant to move to the cloud, right? Because of the data integrity issue, because of the confidentiality issue. So there are certain misconceptions that certain organizations, specifically the board, they face in terms of moving to the cloud. Certain tools, Power BI or data visualization tools that something helps a finance professional to take to assess the information, analyze the information in a proper way and take the informed decision. ERP, of course, we know what ERP is, enterprise resource planning, wherein you get multiple modules. There are many ERPs available in the market, right? Is it visible to all of you? Okay. So maybe I'll touch base on some of the critical points from the ERP perspective, what it brings onto the table, which can be leveraged. One is the uniformity in the process and the controls. So the moment you implement in ERP, you get multiple modules, multiple business functions can be leveraged through that application, and which are integrated to each other. And many a times these are real-time integrations, right? The moment you perform an activity, your transaction get processed, your accounting record get generated in the back end. You don't have to even recall your general ledger account to pass an accounting entry. You can streamline your process by automating few of the tasks, right? So there are organizations who have implemented ERP, but they still use ERP more like a off-the-shelf kind of a package. But we are not leveraging the potential of a ERP to automate processes which are currently happening in a manual way. So you can implement certain control, you can configure certain controls in more automated fashion when it comes to an ERP. It also enables you to get a real-time update. Activities happening in one unit of the organization, and then you have the information handy to sort of assess and take the decision. You can configure ERP in a way that that meets your requirement, that meets the requirement of say regulator, or it meets the compliance requirement as well. For example, in one of the organization I have seen, they have configured in ERP to even generate a financial statement aligned to the Schedule 3 requirement. Segregation of duty, I think one of the previous panelists have spoken about the segregation of duty. That's very, very key in any control environment, because that has got potential to bypass everything, even in your controls framework. If you have a person having access to critical functionality, then your control framework, whatever it is, can be bypassed very easily. So that's a very important and very key consideration for you to evaluate, assess when it comes to any software for that matter. The second aspect is robotic process automation. Now that's widely used in the GCC kind of a setup, wherein which basically automates some of the mundane tasks, some of the regular tasks that can be automated. You don't have to have a person sitting to do that task, and which is again prone to manual errors, right? That can be avoided if you put a RPA in place. Now what is RPA? RPA is nothing but your script only, right? It's a script which basically triggers in the background and then performs a transaction. It is nothing new, it's just a term coined to perform the same task again and again without any error. But it also comes with some certain challenges that we'll talk about later. It also helps you in doing a compliance monitoring. One of my clients, in fact, they have gone to the extent of, I don't know whether you have heard about the continuous compliance monitoring, wherein basically what it does is, so you can configure a RPA in a way that, say for example, if you have configured a control in the system. Now how do you assess whether that control, what is configured in the system, is working fine throughout the year, throughout the reporting period, right? What kind of a comfort that you're going to get with that automation that's working fine? Nobody is touching anything, nobody is changing anything. What is the integrity parameter that is there, which basically gives you a comfort, or management a comfort, that this automated controls are working fine? So that's where your continuous control monitoring, continuous compliance monitoring comes into play, wherein bot is deployed to basically assess the changes to table parameters, which in the background, if any changes to those parameters, immediately mail gets triggered to the management for them to assess whether is there any change which has happened to the particular control activity. So that's how they basically gain comfort on the controls which is configured into the system. So RBA helps you doing it. Most of the matured environments have implemented robotic process automation. There are still a lot of scope for the improvement here again. Coming to artificial intelligence, I think that's a hot cake now. Everybody is talking about artificial intelligence. Even the smallest of automation is categorized or bucket under artificial intelligence, right? So what is the essence of artificial intelligence? Unless and until you have a machine learning in place, which machine learns based on the behavior, based on the patterns, AI will not even throw out the results properly, right? So what can be done through an AI? You can still use it from the finance data entry perspective. Certain tasks, some certain complex tasks can be automated through an AI. It will also help you do an intelligent assessment from the MIS perspective. It reads lots of data and gives you a pattern, gives you an exception. Again, depends on how you configure that to your requirement, but management can leverage the benefits of artificial intelligence so far as forecasting or analytics is concerned. Then of course fraud detection. So again, in continue to the analytics, again, if there are any changes to the patterns that that tool identifies, that could be a potential fraud. It doesn't mean that it will identify a fraud, that you need to analyze it. Of course, any automation coupled with manual review always gives you better comfort, right? You cannot 100% rather rely on the automation. Some element of monitoring over those automations is also required. Cloud computing, of course, as I mentioned earlier, there are a lot of hesitancy still to move to the cloud. People don't know the power of the cloud, to what extent they can utilize the cloud computing aspect. So what are the benefits if you move to the cloud? Of course, global accessibility. Of course, it also reduces your cost. You can get rid of your IT related tasks which is not your core operation. You can actually leverage certain controls which cloud vendors, if you don't have a cloud vendor, if you want to have your own private cloud, you can implement those controls at one place and leverage for our entire organization. So the benefits of cloud computing is many. As people are still going to the cloud, there are challenges, but the benefits are more. Mobile technology, of course, we are using it. We can't get rid of mobile, right? Anytime soon, we will not do that. So how you can leverage the mobile technology to create a workflow or approve the workflows which is coming. You can analyze the data in your mobile phones, tablets, etc. So these are the options available to us as a finance professional to leverage from the technology front. Coming to data visualization, there are many tools available in the market which can be integrated to your core financial application to get the real-time data, do a pattern analysis, provide exception reporting that can be analyzed by the management, and which will help them take the decision, which will help them tackle the exceptions as and when it occurs. You can customize it to any requirement. You need to get the data, right? So you need to configure in a way that it real-time interacts with your core financial applications and pull out the information for your analysis. So these are the tools that I wanted to talk about, which are available in the market. There is a new thing, blockchain as well, that is coming into play, which is kind of so basically you can leverage the power of the blockchain as well, wherein which basically ensures the data integrity of it, right? Now, so when we talk about technology, when we talk about the benefits, there are challenges. There are challenges which comes along with the technology, right? Sometimes technology itself is a challenge, right? To how to manage that technology itself is a challenge. So starting with say ERP is a good application to have for your business processes, but depends on how you are configuring it. If you're not configuring it to its full potential, you may not reap the benefits of it. Sometimes you employ a vendor to implement an ERP, but so what vendor suggests, implement your process to align to the ERP requirement. It should be other way, right? ERP should be tailored to your requirement, but depends on what kind of vendor that you hire and what kind of input that you get. It matters, right? You are changing your process to align to the ERP, and ERP is getting modified to your requirement. There is a huge difference within that. So it's important that you configure it in a right way. You try to automate the process as much as possible to leverage the benefits of it. There are certain barriers in terms of implementation cost. Of course, ERP comes with a higher cost, right? And also you need to maintain it quite often. For example, SAP every 5 years, 10 years, they will come out with a new version and then they will get rid of old version. They will mandate you to upgrade your system. There is a cost involved, there is a maintenance involved. So these are the few things that one needs to consider. When you are going for a new technology, whether RPA, AI or ERP or any other technology for that matter, reskilling of your existing workforce is very, very important, right? If you don't reskill your workforce or upskill your workforce, they may not be able to tackle that new technology in a way which benefits you. And it also warrants mental change, right? It's a change management in a wider parlance, we call it. As a human, we always resist change, right? How do you get rid of those hesitation is basically upskilling them, reskilling them wherever required. Cyber security, I think more than a couple of times we spoke about cyber security. Technology comes with a risk. The more we automate stuff, the more we go to the cloud, cyber security risk is very important for management to assess to what extent it poses the risk from the integrity perspective, from the confidentiality perspective. So you need to assess. So this could be one of the barriers. This one of the main barrier that even board members are talking about in their meetings. And then of course, garbage in, garbage out. Whatever you configure, whatever technology you use, if you're not configuring it properly, you will get the junk result, right? So these are some of the barriers I wanted to talk about. Now, what are the strategies? Of course, it starts with what is the management object.
Ashish, can we keep the strategy into question answer more?
Okay, sure. I think that is what I wanted to sort of cover from the technology perspective. So maybe we'll take some questions towards the end. With this, I put curtains to my session.
Yeah,
Thank you.
No, strategy is very important point, and possibly strategy from the perspective of a smaller and small accounting firms, because in what state they are today and how and where they need to reach and how they should move, and that is what the strategy becomes more important. So it's very important point. Maybe in question answer somebody would ask, then you can respond as to how they can move forward to adopt and adapt to the technology. And we have Ajit, a partner KPMG, and who has been talking on the ESG and sustainability. And I know it's very complex topic in terms of what TK Arun said and what the earlier speaker in the morning said. But then summarizing those standards, and particularly to what extent the regulator should, NAFRA is sitting here, to what extent NAFRA should look into the ESG compliance when they inspect and when they investigate. That's an aspect Ajit would try to cover, maybe would try to reflect upon in another 10 minutes time.
Good afternoon, everyone. As I was walking in and I was looking at the food, I was really disappointed to see that the food was really delicious. Because our challenge as speakers in a post-lunch session is directly proportional to how delicious the food is, right? The more delicious it is, the more efforts we have to put in as speakers. So please do try and pay attention. I'll try and make it as simple as possible. My topic, as Sir said, was to talk about the role of interlinkage between sustainability reporting and financial reporting, and in terms of how various regulators are looking at it and possibly could look at it. From a sustainability reporting framework standpoint, there are 2 or 3 broad streams which we see internationally, including in India, right? The one stream, very prominent stream, is in the European Union, where there are very detailed sustainability reporting standards which have been rolled out. There is a roadmap which has been laid out in terms of preparation. There's a roadmap which has been laid out in terms of how auditors would provide assurance, first limited assurance and then reasonable assurance. That is one broad stream, a very prominent stream, and it's taken with a lot of seriousness in that jurisdiction. The other stream which is not yet kicked off is the United States, where there have been some draft regulations, but it's not yet come through. It's still being debated both politically and in the profession, and it's yet to be notified by the regulator there. So that is another stream where they had kind of brought out some draft guidelines on various sustainability reporting requirements. In India, as you are aware, there are what we call as the BRSR, the Business Reporting Responsibility and Sustainability Reporting report, and within that, last year was the first year when there was a element of that called BRSR core, which was required to be assured by independent auditors, reasonable assurance at that, and there has been some development around it in terms of proposal by SEBI to say that that would be changed to assessment as opposed to reasonable assurance. That still we are awaiting further clarity on that, but broadly speaking, those are the three streams which we see. And as you can imagine, there are many interlinkages between what companies put out in their sustainability reports and what is set out in the financial statements. And another important element which we've seen very predominantly in the European Union and US, and now we are seeing a lot in India as well, are companies making climate commitments, right? Which is a very important element of what we're going to talk about today. In the sense that a lot of these companies are saying that by 2030 I'll be net zero, by 2040 I will have no emission, very little emissions, and those are very important elements as well. Now, with this context of sustainability reports both in India, Europe and US and climate commitments, let's examine what could be potentially the interlinkages between financial statements and sustainability reporting. The first and foremost is that when a company makes a climate commitment, it is not only a commitment with reference to emissions. There are many elements to it which relate to production process. There are any elements in terms of how they would treat employees, compensate employees. There are many elements with respect to what type of packaging material they would use. A lot of it revolves around climate friendly items being used, right? And those are not only in isolation commitments, but those have consequential impacts as well. Those mean higher cost possibly, right? Those mean whatever plant and machinery I'm using in the production process will have to be retired earlier than planned, and I may have to get newer equipment. So there may be many consequential impacts of what climate commitments companies are making in India, outside India. We are talking of in India, so let's stick to that. We see that being there. So one of the first very important linkages, a lot of people say that the Ind AS standards do not have any specific climate reporting requirements or any elements around that. But there are various elements of existing standards which are impacted by these climate commitments. For example, useful life of fixed assets, right? That is impacted by climate commitments of manufacturing companies. Another example would be when you do impairment assessment as a company, you are expected to forecast your future cash flows. Now your future cash flows will be impacted by your commitment and what you choose to say, how will you get to your climate commitment. If you are saying that your production process will undergo a significant change so that it becomes climate friendly, then your future cash flows will have to reflect the impact of that as well. So therefore, one very important impact is all the climate commitments which companies do make. There is an onus on the preparers of financial statements to review the impact of those commitments on existing items like useful life of fixed assets, future cash flows which are used for impairment assessment, and there may be other elements as well. I just took a couple of examples. The other very important element which preparers of financial statements and preparers of sustainability reports have to be mindful of is the whole element of consistency of approach, consistency of information which is presented in financial statements and sustainability reports. For example, today in the BRSR report, there are detailed disclosures around employees, contract workers, how compensation, what kind of compensation is paid out, KMPs who are there in the company, how many women KMPs do you have. Similarly, there are disclosures around wastage, there are disclosures around water consumption. Many of these have interlinkages with the financial statements as well, and therefore consistency of information is also very critical. Of course, auditors themselves have a requirement of reviewing other information which is included in the audit report or in the annual report with the financial statements. But please remember, the first responsibility is of the preparer of the financial statement, right? So consistency of financial information is also extremely critical. Now, in this trend, you do see regulators overseas, especially in Europe, already looking at this element of consistency and disclosures even today or even in the previous years, given that they have slightly ahead of us in the journey on focusing on climate. The European Securities Regulator published a report where they looked at the annual reports of certain companies and provided observations saying that these elements of which are impacted by climate commitments are missing, right? Similarly, you find that IASB has come up with some exposure drafts on how climate related disclosures can be included in the financial statement. So there's a lot of work happening internationally. In India, for example, we've seen NFRA already come up with some review of financial statements and findings from those in the past for certain companies. As we see the climate commitments kind of increasing and becoming more prominent, I'm sure even those reports would start capturing some elements of these consistency, some elements of these the interlinkages of the climate commitment on the financial statements as well. And I think that's where we are headed to, you know, there's a lot of conversation of an integrated report. That's also a concept which is spoken of internationally. The whole point of integrated report is having one document which is integrated with each other, financial statements, sustainability, which again points to consistency. I think that is the bedrock of what we are trying to achieve here, that while we are having different reports on sustainability information, financial statements, you may have BRSR in India, and many companies publish voluntary sustainability reports, but are we being able to say that we are consistent in terms of what we use, how we use, what we say in those reports? And last but not the least, are we able to assess that whatever commitments we are making in our investor presentations to the wider world, are we able to properly capture that impact of that on various elements of our financial statements and disclosures, accounting policies? You know, one of the very important findings which has been published by NFRA as part of the financial statements review is the whole elements of judgments, estimates, and the lack of details in that. This is another area which would be significantly impacted by climate commitments in terms of judgment around useful life, in terms of estimates around useful life. All of those would kind of be impacted. So I think that's broadly what we are looking at in context of the interlinkage between sustainability reporting and financial reporting. Thank you.
Thank you, Ajit, for emphasizing the point of ESG reporting, and particularly from the regulator's perspective. If I were to be a regulator and I were to be looking into inspection, investigation of any financial statements, possibly I would also, I'm sure a regulator would like to look into as to how the business risk has been assessed by the auditor. And when you assess the business risk, you cannot do without assessing the climate risk and the ESG risk. So that becomes very important. There starts the linkages. And as an investor, if I were to look into the financial reporting to form a basis for my trust, I would like to look into the annual reports, the board of directors report, and also the MDA, and would like to see how they have been drafted. They are plain, simple language. They are high-sounding statements, and if they are high-sounding statements, my trust in that management, in that auditor, to that extent would be prima facie eroded. I remember having seen some of the largest multinational companies, best-known multinational companies' annual report reading. They make all sort of claims about their future prospects, profile, and their positioning globally and nationally, which over a period of time turns out to be, if I can term, even on this public platform, as a fraudulent statement. I would not be exaggerating. And we have a regulator sitting here. I would request him to place his regulatory perspective about the NAFRA and NAFRA finding. And then we will certainly have Mr. MP Vijay Kumar, and before we may not have enough time to preface his address, and we were talking about 10 minutes more or less. I recall, I suddenly came to my experience, my interaction with Dr. P. Prakash Tandon. You have been knowing, he was the first chairman of Hindustan, first Indian chairman of Hindustan Lever. When he was entrusted with the responsibility of one of the largest PSU in the country to be a chairman, he called his CFO and he asked him that I want your audited financial statement on 1st of April. Now CFO was amazed, was bewildered. He said, what he's talking about? And he said, sir, how this is possible? This cannot be done. I said, you call your ask your auditor. Sir, auditor has refused. He said, call your auditors, you come with your team. I would explain as to how can you have the audited accounts done by 1st of April. And he started that process and he got his accounts audited financial statements were right on his table on 1st of April. I, in my own way, attempted this, and believe me, by 7th of April, we had audited financial statements on our table. So 10 minutes, or for that matter, timing is not. The point is how do you plan and how you do stagger your steps to ensure you are able to achieve what you want to. With that, over to you.
Good afternoon, everyone. Am I audible? Yeah. First of all, it's my pleasure to be part of this conference. And these two topics, the financial reporting and the accounting. And in financial reporting, I will also include the auditing area as well. So these are very close to my heart, and really, Dr. Haldia ji, thank you for giving me an opportunity to share my thoughts in this. And I also would like to so thank office bearers of SOCHAM, and of course you all audience. In the afternoon session, you are all waiting here to hear some of our thoughts. And then one important disclaimer, being part of an independent regulator, I have to make, the views expressed or the remarks which I make here are my individual views and not that of the NFRA or its executive body. Of course, many of the auditors would like to do that in their audit reports, that kind of report. Now, coming to that topic, Dr. Haldia ji has mentioned the area given to me is increasing regulator focus on financial reporting. Yes, in India, many of you will feel that it's there is a lot of increase of the focus of the regulators, independent regulators, especially on the financial reporting area. Yes, globally, if you are aware, in many other jurisdictions, this is almost more than 2 decades. There are independent regulator and there is an enhanced focus on financial reporting. Especially if you look at US, it is there since 1930. When earlier chairperson mentioned about that case Kruger and Toll, etc. When Security Exchange Commission came in, one of the responsibility put on, first responsibility was you must review the financial statements of listed companies at least once in 3 years. That is the kind of the. But India, yes, it is a new, you can say, enhanced focus, and we are a young regulator, just 6 years old, but it has its advantages because we already know we have the benefit of how the globally other regulator, etc., have dealt with these areas. And of course, there is also a challenge for us also because many times our performance is gauged from what is expected there in our peer group. Now, coming to the topic, here I am going to focus more on the financial reporting area as of now, Dr. Haldia ji, if you permit me. ESG is in India still we are, I would say that we are still young. Even the corporates and the auditors, we have not reached the level where regulator now need to really put more focus on what has been reported as of now. So I'll now, first focus more on the financial reporting areas. First, about the NFRA's learnings from its disciplinary activities. First and foremost thing, it's important for the auditors as well as the preparers of financial statement to understand the context of audit in India. It comprises of 3 elements actually. The first one is giving a reasonable assurance on financial statements, whether accounts are in line with the applicable financial reporting framework or not. That is objective. In some jurisdictions like US, etc., that is one of the objective, and that is the purpose of the financials. But in India, we have further more requirement. The second one is assurance on the internal control or financial reporting, which came in 2013, and it is similar to the US requirement. And the third one is we have a lot of other regulatory requirements like CARO, which has been there since 1975-78, but yet in 2020 it has got enhanced in a big way. And then we also have a Companies Act. Auditors have certain additional reporting responsibilities to check whether the transactions, etc., of the company are they prejudicial to the interest of the company or not. It is slightly beyond the normal audit, which I mentioned in the first phase. And then most important is on this 143.12 subsection 12, reporting on the fraud related areas. It's a very, very, we can say, very important responsibility. And in these 3, one important thing which we notice is that the review of this, audit of this internal control or financial reporting is quite a neglected area actually. Yes, we do not have a standard like US auditing standard AS2201, which is there in US. And also, in India, we have the framework for that ICFR for the corporates also to use. We have restricted ourselves to a guidance note derived from the institute, which is based on the SA 315 auditing standard. But globally, there are other framework like COSO, etc., which are well recognized, and they use that. So, but yes, even with that, the attention paid to that internal control of financial reporting is less, which we notice. And in my view, if the auditor does that well, very well, and the management also takes care of that area, then your audit is 90% will go smoothly. The other 2 objectives which I mentioned, reasonable assurance and fraud related reporting, you will achieve that, provided that internal control of financial reporting, if you address that in true spirit. But that's not happening. And of course, regarding the fraud related responsibility, I think in India we need to get over this old 150 years old Kingston Cotton Mills Justice Loeb's statement, auditor is a watchdog, not a bloodhound. We should not be doing a selective reading. Justice Loeb himself, he said in his judgment, after saying auditor is a watchdog, not a bloodhound, he said, if there is anything arouses auditor suspicion, he should probe it to the bottom. But we said that sentence is not applicable. But the first one, watchdog and bloodhound, is applicable. So we should get over that. Of course, similar statement was made by another UK judgment, Lord Alveston, after 50 years from that case. He made the similar statement. And more importantly, even in India, our Supreme Court, I don't know how many of you have seen this case, ICAI versus PK Mukherjee case of 1968. In that, actually they have referred to these cases. And they didn't refer to, Supreme Court didn't refer those cases to say that auditor is a watchdog and not a bloodhound. No, they referred it to tell that the Justice Loeb has said that if something is arouses your suspicion, auditor suspicion, he should probe it to the bottom. And this PK Mukherjee case was a case where auditor was held guilty because in one of audits of a provident fund of a, some of you might be knowing, famous media house, Anand Bazar Patrika Limited. Their employees' provident fund, in that what they had done was, the provident fund had given a loan to the Anand Bazar Patrika, which they were not supposed to give. Provident fund trusts are not supposed to give loan back to the company. And what they had done was, that Anand Bazar Patrika issued checks in repayment of those loans and told the trust that don't encash it, just reduce the loan balance in your books. It means the loans in the Provident Fund books were removed, otherwise it would have raised the question, and the bank reconciliation showed that, and checks were not entered. And this the auditor knew, and he asked the management. Management gave some, board of directors also said it was error, we will now take back money with interest. But the Supreme Court held, no, you should have actually reported in your audit report, this is a very fraudulent transaction which has happened. So can you correlate this transaction in our orders of NFRA on this Cafe Coffee Day cases? Checks were issued, but where only book entries were passed, but were never presented. So this, we have to actually learn some of these, old, sort of learnings which have happened. And you see many of our orders, lot of these orders, as our chairperson in the morning inaugural address said, they are all related to the cases where there is a lot of fraudulent transactions have happened. It is not the case of some clean company where the auditor did not maintain proper work papers or anything where he has got punished. But these are all cases, you yourself will see, these are actually cases where there is a serious damage to the public interest has happened. And there is a lot of learning to be done from that perspective. And I'm sure if the Justice Lopes of Kingston Cotton Mills, if he was alive today, he would agree with all the LMFRA orders on these cases. Now, coming to another area, which is both to the auditors and the management, the accounting estimates, auditing accounting estimates, that's ECL and fair value or impairment of assets. This is an area of concern also if you see a lot of our orders. Especially the expected credit loss for financial assets under the India's 109. Yes, it is a quite a judgmental area, requires a lot of management judgment and also involvement of other subject matter experts like credit risk experts or the collection experts, etc. But especially when it comes to the non-banking finance companies, etc., or the financial institutions, this is much more complex than what is there in the Ind AS 109. Many times you have seen the orders of Reliance and others which were put out, where we have said that the auditor just simply did a arithmetical calculation of some 3 important parameters of credit risk: probability of default, loss given default, and exposure default. Just multiplied them, whatever management gave, and said that yes, we achieved the objective. That's not the objective. Any times when you are doing the audit of this financial institution, etc., and if the entity is using this, first auditors as well as management go back. These terms originate, this concept originate in the banking sector's capital adequacy framework, advanced internal rating based approaches. And there are a lot of controls, checks and balances required on that. Before, probability of default is not somebody is just saying 5% probability of default. No, how did you arrive at that? There are huge requirements of historical loss data and application of statistical methods and plus the management judgment to arrive at that. And in this, I would say that when we look at from NFRA's perspective, we do not just look at based on the 109, some prescription, etc. We also look at, are there any other guidelines given by the sector specific regulators, etc. Like if you go and see, Basel Committee on Banking Supervision has plenty of guidance around that. In fact, that Basel Committee on Banking Supervision actually made the requirement of IFRS 9 much more stricter to the banks. They say that banks, your main risk is credit risk. You should be really expert. You should not be taking all those practical expedients and all those things you should avoid. And they have given to the audit committees also enough guidance, and to the auditors also how you should audit it. And similarly, the International Auditing and Assurance Standard Board has also given guidance. That also, one should look at. And now coming to the other area which we are noticing on the impairment of non-financial assets, and where there is a fair value, etc. is used. This is also another area where there are certain very basic kind of things, checks are not being done by the management as well as by the auditors. Like a fair value expert give the report, valuation report, and where simple things that you should check what is the purpose or objective of that report. And the valuation report says this valuation report is meant for income tax purposes. But the auditors and management should check whether is it applicable, does it meet the requirement of Ind AS 113? And the assumptions, etc., which are used, one should be checking it. But unfortunately, no such checks have been done. And sometimes the reports called credit appraisal memo, I don't know what for it was meant, that is considered as a fair value report. So this is one area, and another area is also some fair value experts have also reports they gave net asset based valuation. But net asset based valuation, how simply they did? They took reserves and surplus and capital divided by number of shares, that is the fair value, unlisted company. Gentlemen, at least have a look at whether that reserves and capital, what are the nature of assets? Do we need to make an adjustment to those assets? Say, imagine if there is that reserves and surplus is represented by a bank balance in Iraq, will you be able to get that? Is it net asset value? Just 2 minutes, sir. So this is another area which the auditors and the management both actually need to look at. And now coming to two areas where I would like in India need to introspect and actually come out, do a research also, the financial, whether the auditors or the accountants. One is this going concern basis of accounting. The Ind AS or the IFRS, it's actually mixes of liquidation basis of accounting and going concern basis of accounting. And in the process, it's quite difficult for the auditors also to audit, and also for the management to decide, should they change the basis of accounting? Should they change the basis of accounting for the entire financial statement? Should they change it only for a few assets? That's why here I would say that the US GAAP is much better. Topic 205/30 and topic 2040. Note this, they are very good. They clearly distinguish when you should change your basis of accounting to a liquidation basis of accounting, and when you should only restrict yourself to giving a disclosure, that is when there is a going concern is as a fact. And another area, last one I want to mention is consolidated financial statements. In India, we are actually separate financial statement, consolidated financial statement, both are actually, some companies give prominence to CFS, some companies give to SFS. In this whole process, neither of the objectives of the investors we are meeting. This is also one area I think as a profession we should actually look at where should we move. And we shouldn't be so distracted by things like what happens in taxation, what happens in dividend distribution. There are other regulators who are ready to take care of those issues. So these are the things which just I want to draw your attention. With this, once again, thanking Dr. Haldiaji and you all people, I would conclude my thoughts on this.
Very comprehensive and highlighting those critical issues. There are a large number of issues highlighting those critical issues. Now we have Mr. MP Vijay Kumar already online, but then, as I promised earlier, we'll have first a Q&A. So anybody who has any questions, please raise your hands. If you have some question, you may ask, you may address to any of the panelists here. And we have the distinguished experts from the earlier session as well. So if you have any question, feel free to raise. We have another 15 minutes for that, please. But questions, and then we will respond to them. Right.
With regard to that climate
Sir, you raise a very valid question. This was also discussed internationally at an IFRIC or the Interpretation Committee of the IASB or the IFRS Foundation. They spoke of this, looked at this matter, and they effectively said that they have explained in which situations will you have a constructive obligation and in which situations will you not have. And there is also an example which they have illustration which they have used. I think you maybe we can discuss that offline because we'll need some more time to explain that. But there is a very detailed discussion around that in there, in terms of when do you recognize a obligation in the financial statements.
Any other question? Any other question, observation or comment? Mr. MP Vijay Kumar, welcome. Good afternoon.
So very good afternoon, sir.
Yeah, you would have a refreshing, experience after, might be after a very hectic board meeting.
Yeah.
Right.
No, but I was there last 15 minutes.
Right.
To
Right.
visit deliberations.
Right. Any other question? Somebody, even if not a question, would express his thoughts on the topics that we have discussed? So at least I will not feel guilty of not giving an opportunity for the question answer. So thank you very much. Now we have Mr. MP Vijay Kumar. I think he doesn't need any introduction. And we have already introduced, I have already introduced him in the beginning of the session. And I also, why this topic has been chosen and why Mr. MP Vijay Kumar has been chosen as an expert. As I said, we have to distinguish what is art and what is science. Understanding technical standard is a science. Implementing those and complying with those is a art. We need to master in the art as much as we need to master in the science. Possibly we need to, if you ask my experience as a manager, we need to master more in the art than in the science. Right, and I had explained you that if someone wants to manage the time and the quality of compliance, then your financial statements, audited financial statement can be available to you on the 1st of April itself. And that experience I shared 20 years ago, 25 years ago. That's not the today's experience that I have shared, I had shared with you. So with that, I hand it over to Mr. MP Vijay Kumar on organizing for accounting standard compliance. And I'm sure when he's talking about, he would talk within the perspective of how a company should organize itself, and to that extent, how an auditing firm should organize itself. Over to you, sir.
Thank you, Dr. Haldia. Greetings to all the members at the conference and to the fellow panelists. Thankful forever to Ashochan and Dr. Haldia for the opportunity to consistently participate in Ashochan events. I'd love to be there in person, and this is the second occasion where Ashochan has been so kind enough to give me an opportunity to connect on video for a reason that I was just not able to reschedule my calendar. And thankful to all the participants also for the understanding. I'm sure all of you had very good takeaways right through the day. My loss that I was not there in person, I couldn't pick up, but I'm extremely keen to watch the YouTube recording of this whenever it's available to understand what's happened during the day. In fact, originally Dr. Haldia asked me to speak around Ind AS 117, but I think the format took a different shape, and I think everything which happens is for the good. Something like Ind AS 117 would have required a minimum 2-3 hours of a session for introducing it in a very understandable manner where one gets confidence on this standard. But this particular topic initially looked a little high level for me. Organizing for accounting standard compliance, basically an entity organizing itself for accounting standard compliance from a governance perspective. But as I started preparing last 2 days to put together my thoughts, and also the fact that I will just have a little less than 15 minutes to share, I actually started enjoying this topic quite a bit, and I put together some 5 points which I can share with you. The fourth and fifth, of course, are the most relevant ones. Obviously, I have to keep it to the last. The third is relevant. The first two are probably more of an introduction. The first of it is, some of you have heard me on this earlier, that I have been a very firm believer that financial reporting is a communication. The balance sheet, income statement, cash flow statement, sourcing, notes, accounts, all of them are a communication. Just like each of us, whether it is in our personal life or professional life, when someone communicates to us, when some other person communicates to us, each of us have an expectation that the communication has to be clear, no ambiguity. The communication has to be complete, not half. And the communication has to be candid and not something very hold back. I call these as the 3 C's of communication. The financial statements which we prepare and as auditors which we opine upon are a communication, and this communication should always pass the 3 C's test of ensuring it is clear, it is complete, and it is candid. The second observation which I would like to make, and this is all my experience, there could be some of you who might have a different experience. Pardon me if my experience doesn't sync with your own experience. I've seen in my 30 years of career that organizations have been struggling for investment in accounting teams, teams for financial reporting, teams for doing the accounting work. There used to be an era where accountants were so very close to the principal owners of the business, and accountants were sort of a celebrated lot. They were actually the confidant, DAT confidants of the principal owners of the business. But as time passed by, at least my generation of 30 years which I've seen, for industry, it's big, irrespective of the size of the company, whether it's a small, medium or large, it's become extremely difficult to get talent for accounting function, get talent for financial reporting function, and to retain them. And that's a hard reality. Probably because this function is now probably lesser relevance in the eyes of those leading the organizations, etc. I would strongly urge that the managements of organizations need to realize that unless the basic accounting, the record of transactions is correct, particularly with all this ERP IT systems which are there, where we blindly believe the output, it will all become a case of GIGO, garbage in and garbage out. And my view, accountants bring substantial value in terms of internal controls. And it is very important that accountants have to be recognized in business organizations and empowered appropriately. And it is a reasonably specialized function. Financial statements preparation is not just a spreadsheet exercise, take in trial balance, group them and put it like, it's not like that. In fact, financial statements, more so in the context of Ind AS, has enormous amount of judgments and estimates to be done. And these kind of judgments and estimates can be done only by a seasoned finance professional, and more so who has a deep understanding of the business. If these are not there, it's extremely difficult for somebody to prepare the financial statements. I heard Vidyadhar speaking about impairments, valuation, all of that stuff. And unless the accounting fraternity within the business organization has the ability to understand what the business is and the outlook of the business is in the foreseeable future, it's just not possible for us to arrive at the present value of the future cash flows or fair value of the various assets which are being carried forward, etc. Same is the case with consolidated financial statements. There are many who still believe consolidation is just a line-by-line addition. It's not a line-by-line addition. Maybe in AS 21, it looked as simple as line by line addition, but it is not a line by line addition. Even as we speak today, there are many entities who are not aware that, particularly unlisted entities, and I've come across a couple of listed ones who are aware that there is a requirement to consolidate, there's a requirement to consolidate, that awareness is still missing. It's not because the directors are not aware, audit committees are not aware, it's just that those companies do not have enough accounting resources within the organization, and that's a substantial area where all of us need to think through as to how do we enable accounting fraternity to be available to the industry. The third point which I'd like to share, which I said is a relevant category before I go to the fourth and fifth, is relating to the CFOs. Most organizations over time, CFOs have sort of become a little bit of a celebrated title, and most of us get recognized or identified with raising resources, capital, debt, listing, reducing costs, different sources of funding, participating in M&A activities or divestment of business, etc. And with this, what I have seen over a period of time is that the head of the finance of an organization's own competency levels, with due respect, no offense to anyone, the time, it's just the ability of investing time to keep updated with all of the changes which are happening. The knowledge of accounting standards, knowledge of audit standards, knowledge of company law, they've all shrunk, and they tend to rely on people in the organization who are relatively less experienced, relatively. So when the head of the function has much higher priorities where they're recognized versus qualitative financial statements, that's again of risk. It's important to ensure that the entire CFO suite, the audit committees realize that the CFO's one of the primary responsibilities, maybe 60% of the KRA or something, is actually qualitative financial statements preparation, timely qualitative financial statements. And it is very important for them to do this because financial statements are the basis for growth capital. Financial statements are the basis for retaining capital including debt. And hence it's important that CFO should be mandated, should be allowed to focus largely on quality and timely financial statements, and they should be measured on that. The fourth point which I'd like to mention is relating to the audit committee. I'm seeing over a period of time quality improving, but like everything in life, it is a journey. A few observations I'd like to make in the context of audit committee for us to help ourselves have a right governance for complying with accounting standards and quality of financial statements. First and foremost is to ensure that the committee has at the minimum 2 or 3 people who have a deep expertise in preparing or auditing financial statements. Boards where the number of members are only 7 or 9 might find it difficult to get 2 people who have this experience. So those cases I would encourage at least have as an invitee subject matter experts who can be present there and help the organization, because ultimately audit committee is responsible, the board is also responsible. So it's while you can't have 2-3 very experienced preparers or auditors on the board, you need to find a solution on that. The second is to have members in audit committee who can actually give time in reading the financial statements and come prepared for the meetings. Why it is important? Because my experience is the moment couple of members read the 70-page financial statements, including notes to accounts and come, it actually puts both the auditors and the CFO's organization on alert. And I found that the quality automatically improves. So you require people who can actually spend the time and have the ability to read those 60-70 pages in 6-7 hours one day before the meeting, or just at the commencement of meeting and wait. That's an extremely important one. The third point which I'd like to highlight and I strongly encourage, in fact, personally I would like it to be mandated in law. Of course, it's my personal view. that audit committee meetings need to happen only in person and not on a VC. Because these meetings, when they are held in person, the members, some of them participate and the chairman would drive people to participate, and those who don't participate also, the chairman will get the benefit of understanding their views based on how they are responding to the discussions. And that part is pretty important. In fact, there are many accounting items where non-accounting people also, the way they look at things gives a good insight. And it's important that audit committee meetings cannot be a checkbox item. It is serious business, and people need to spend that 3, 4, 5 hours for deliberating the discussions of the financial statements. And the other good practice which I have seen evolving over time is have at least 2 meetings a year independent of management. Excluding the management, the audit committee should have meetings with statutory auditors and internal auditors and assess. And unless you pull them, you will not get the views. You need to keep pulling them to tell them what is their experience, what are areas of improvement, what are their concerns on, how estimates are being done, how judgments are being done, etc. That part is again an important one, and I found it to be extremely beneficial. It takes time to bring about these changes, but once people see the benefit, I think people are appreciating it, and the boards where I have experience, they are finding it good. The next is to have audit quality indicators at the beginning of each year to discuss with the auditors concerned that we would like to look at your performance based on these 5, 6, 7, 8 indicators. And just give an example, sir. Vast subject. For example, how much time would be there on the engagement partner? How many hours of review partner? What is the engagement team composition? How many hours would they spend? You need to document all this things because audit ultimately is a function of all of this community of people who are done. What is the kind of training systems which they are internally following? So there are some indicators on which you can measure them at the end of each year, and that can be the basis for evaluating their continuation, etc. later. And for those in industry, I have a small recommendation. We all know that audit fees, many audit firms struggle to invest in technology and quality people because of audit fees not being adequate. I think it's a collective work we have to do, and I know that the audit fees is an important area and fees need to be increased. In fact, in this world we come across this LN process where people quote, so it becomes difficult even for the boards to decide for a higher fee when the quotation is so low. But I think collectively we have to work for it. Unless the auditors are able to get reasonably good remuneration, they can't invest in tools and high quality people. It's extremely important for us. And the last point of the audit committee is to ensure that audit committees spend substantial amount of time on internal audits, because statutory audits, despite all the responsibilities, it does have certain limitations in terms of the extent of time they spend. Whereas internal audits can be made very exhaustive, and they do bring value for the management in terms of efficiency of business as well. And audit committees need to spend time both in selection of the auditors, that is audit statutory or internal auditors, handshake between the two auditors to define the scope of work and follow through of the observations which have been done and whether those rectifications have been done or not. Coming to the fifth point, the last point, a few thoughts on board level governance. One is, I would encourage many companies, because of this listing timeline conditions and all, they tend to merge the audit committee and board meetings together so that all the board members come together. And most occasions what happens is, while the financial statements are being presented, you start discussing about why the revenue growth has not happened, why the expense is like this. You start discussing on business related items. Audit is all about financial statements as is, the quality of accounting policies applied, judgments done. Why business has grown, reduced, not expense this, that is a board level discussion. So it's very important that boards should allow audit committees to focus only on financial statements, accounting policies, estimates, judgments, and business performance related discussion should be kept completely only to the board, and those discussions should not allow to disturb the audit committee's deliberations. So that has to be done separate. It does take time, but it has to be separated and done. And the next point I'd like to mention here is the audit committee chairman should be encouraged to formally present to the board how he has conducted the meeting, what are the observations which he has got arising out of the meetings, and give the board the perspective of the accounting, key accounting matters which are there. It will give confidence to the board as well, and the audit committee chair's responsibility will also go on. These are some of the practices which I have sort of observed practice, and I found them pretty useful. Of course, all of this is a journey. The standards are quite complex, they're not very easy. But as long as there is no malified intent, if there are some errors, I'm sure all the regulators will look at it in the right perspective. But it's important that we should have a right governance structure, and I've shared some thoughts within this limited time available. Thank you, Dr. Haldia, once again for the invite, and more importantly, thanks for allowing me to join on video. And my loss, I was not there in person.
No, thank you very much. If you stay for some time, if somebody has any question to raise to Mr. MP Vijay Kumar, any question somebody would like to raise? Yeah, please.
First of all, thank you, sir. Everything you have said have been very, very insightful. So, I'm a chartered accountant from an audit profession. So, whatever said has been very relevant. I would just like to say one thing. Audit. So, I think most of the auditors want to do their work rightfully, and we do it. But as an auditor, the strict compliances, all these regulations worries me only from one perspective. So how do we make management? So audit committee and board comes at a very later stage. Auditors generally are coordinating with the management. How we draw these awareness among the management about the financial reporting. So besides listed company, there are too many unlisted companies also, which is part of Indian economy. And how, like, you know, these orders, regulators, they are directly applicable either on the company or on the auditors, but perhaps not on the individual people or the financial controllers or CFOs. So sometimes even when an auditor has a good intention to deliver and do their work, but there is a lot of pressure from the management and they don't understand the importance of the financial reporting. So how do we raise that awareness among the management towards the audit quality, documentation, audit fees? So all of them. Thank you.
Got it. Thank you for that query. See, there are two parts here. One is, I'm sure, an industry forum like ASHACHAM will probably have some forum where in meetings or program of CEOs or managements, we can definitely disseminate how important it is for them to do it. But from a practical point of view, if I were you and I was in practice for about 8-10 years, signing on financial statements as an auditor, what you mentioned is a ground reality. It's ground reality, and I fully acknowledge the same. But times have changed, and there is increased awareness and dissemination happening for all the people to know how important quality of financial statements are and the consequences of not having the right financial statements. What I would encourage, and I use the word excellence is a journey and these are a journey. What I would encourage is the partner concern, the audit firm engagement partner concern, whoever it is, should invest time in terms of engaging with the management, spend a bit of time and keep educating over a period of time. So like for example, you have a good 1 year of time for you with reference to a particular financial year for audit to be completed. You need to keep engaging with them one couple of months, keep updating them about the changing developments, build conversations to keep them informed about importance of quality financial statements and things like that. There would still be some managements who will be adamant and refuse to change, or who will have vested interest. I think law gives enough empowerment to the auditors. There is enough and more empowerment to the auditors, whether it is reporting tools like CARO, or whether it is reporting tools like EON, emphasis of matter, or where warranted SA 705 itself, or key audit matters SA 701. There are enough tools available for an auditor to communicate. And with this kind of tools which are at disposal, if a management still chooses to ignore the auditor's power, that arrogance needs to be punished. And I think you should exercise that particular option available to you in terms of the various tools of reporting it. And once it's reported, thereafter the discipline will fall into place. But I do fully understand your question. The answer is not as simple as I mentioned to you, but I'm sure I've given you a directional answer. And when I was in practice, situation was not too different, but I had followed this approach. And what I found, one good thing I want to tell is, now we have entrepreneurs who are either second, third generation, who are reasonably well educated, or new first generation entrepreneurs who are also educated. So I think striking a conversation and helping them to understand importance of quality financial statements is not so very difficult. Maybe for unorganized entities, maybe it could be difficult, but once somebody decides to have a corporate structure or limited liability structure, I think he's a reasonably informed promoter or management. I think we should put that effort of helping them to understand and comply with the requirements.
Thank you very much for a comprehensive response. Any other questions? No. No, so that brings us to the end of this session. I will just add only 2 points. One on the question raised. I started my articleship 35 years ago, and I never audited or visited. I started audit in my firm without first meeting the CEO and the CEO for that organization. We refused to start the audit without meeting the CFO and CEOs. That's, I'm saying, 35 years ago. So it is how you impose. You need to act as a friend, guides, and philosopher for the management. If you show your value, they would come forward and they would also value you. Third thing is that you have an audit committee now. You can tell the audit committee, in fact, audit committee is expected to ask you, did you get the cooperation from the management? Did you get all the information from the management? Did you interact with the management? Did you interact with the chief risk officer? Did you interact with the compliance officer? Did you interact with the CFO? Did you interact with the CEO? They are expected to ask you. Even if they do not ask you, you can say that, look, we were expected to assess the business risk, but we had no opportunity to talk to the CFO or the CEO or the chief risk officer. As Mr. MP Vijay Kumar was saying, that you have enough empowerment under the Act. Now you need to only understand that, appreciate that, and enforce that. That's first thing. And second is the point that Mr. MP Vijay Kumar said, that the auditing standards are very difficult to understand. That's very right. And just to say, in one of the interviews together with the ISB chairman, the then ISB chairman in India, he said about one particular accounting standard, that if somebody tells you that he has understood that accounting standard, then believe me, he has not read it. The point is still I'm saying is that while the accounting standards might be difficult to understand and appreciate, but then our endeavor should be, as Mr. MP Vijay Kumar said, our endeavor is to organize ourselves so we are able to best comply with those. So with that, over to you.
Let's have a huge round of applause, ladies and gentlemen. Indeed a pleasure hearing our veterans around the same. So you were just witnessing the last technical session for today's conference, subjected around regulatory focus and technology in financial reporting. I request all our dignitaries to please step forward for a group photograph. And indeed we have Sir MP Vijay Kumar sir on the virtual setup as well. So let's take a E group photograph.
It's a hybrid photograph.
Hybrid group photograph. Let's have a huge round of applause, ladies and gentlemen. On that note, we come to the end of today's conference, the national conference around changing landscape of accounting and reporting, themed around navigating global standards and best practices. And on behalf of the entire SOCHAM team, it's my pleasure and privilege to thank each and every one of you for taking out time for this conference today. And let's hear it for the entire organizing committee of this today's conference. Santosh sir, Basudev sir, and everybody who has been relentlessly and tirelessly working towards making this conference a great success. Let's have a huge round of applause for the entire team.